72 hours. That was the entire distance between euphoria and destruction. 3 trading days, 1 setup, 1 peak, 1 execution. And by the time Friday was over, gold had been crushed, silver had been gutted, and roughly $10 trillion in precious metals wealth had been ripped off screens around the world. Call it a crash if you want, I won't. A crash sounds accidental. A crash sounds random. A crash sounds like nobody saw it coming. This was not random. This was a timed reversal so sharp, so coordinated, and so perfectly placed inside a 72-hour window that the word crash almost hides what really happened. Gold was down hard. Silver was annihilated. Not over a month, not over a week, in hours. And that is the first thing you need to understand. Nothing obvious happened that morning to justify that kind of destruction. No surprise war, no global bank failure, no emergency announcement, no black swan exploding across every major headline. Just silence. Silence on the screens, silence on the anchors, silence while fortunes were erased in real time. But while traders were being liquidated and portfolios were bleeding, Washington was lurching toward a government shutdown. Political chaos was building in the background. Uncertainty was already in the air. And right in the middle of that confusion, the most violent one-day collapse in precious metals history hit like a hammer. You think that timing was an accident? Stay with me, because what happened across Tuesday, Thursday, and Friday was not just volatility. It was a sequence, a chain, a trap that opened, filled, and snapped shut on schedule. And once you see that sequence clearly, you stop looking at Friday as a normal market event. You start looking at it as something much colder. A script. Maybe you held gold, maybe you held silver, maybe you watched positions that took months or years to build get cut to pieces in one afternoon, while the same people who missed the rally tried to tell you this was healthy. It was not healthy. It was not natural. It was not the market calmly finding fair value. This looked far more like a staged unwind built around policy signals, margin pressure, paper selling, and the sudden disappearance of the buyer that usually catches falling metals. And in this video, I'm going to walk through that chain one move at a time. Who set the tone? Who changed the signal? Who stepped away? Why month-end matters? Why paper and physical completely detached? And why this pattern looks disturbingly familiar if you study the last 50 years of silver history. If you want analysis that gets straight to the point, subscribe now. And while you're listening, ask yourself one thing. If this was just a normal correction, why does every piece of it line up so neatly? Let's go back to where the trap was built. Tuesday, January 27, 2026. A policy remark lands. Most people barely notice it. Another political comment. Another piece of background noise. But traders did notice it, because one sentence changed the entire direction of the trade. The message was simple. A weaker dollar would help American business. A weaker dollar would make exports more competitive. America, in effect, should stop acting like a country obsessed with currency strength. To the average person, that sounds dry. To a macro desk, that sounds explosive. Because if the market believes the White House wants a softer dollar, the next move becomes obvious. Sell the dollar, buy hard assets, buy metals, buy what gets repriced when the currency weakens. And that is exactly what happened. Money started moving fast. Hedge funds leaned against the dollar. Asset managers added to gold. Retail traders piled into silver. The trade became crowded because the logic felt clean, simple, and politically endorsed. Weak dollar, strong metals. Tuesday was not the crash. Tuesday was the invitation. Now jump ahead to Thursday, January 29th. This is where the emotional temperature hit its highest point. Gold surged to $5,600 an ounce. Silver blasted to $121. The move had become historic. Silver had gained roughly 68% in January alone, the strongest monthly run since the late 1970s. Everywhere you looked, the mood was the same. Excitement, certainty, greed disguised as conviction. Influencers were calling for $200 silver. Some were calling for $300. Others were speaking as if the move had become unstoppable, as if price itself had proven the thesis forever. Retail money was flooding in. The Silver Trust saw record inflows. The total silver market had swollen into a monster. Portfolios were exploding upward. People who had been ignored for years suddenly looked like geniuses. Thursday night, a lot of traders went to sleep convinced Friday would be another victory lap. They had no idea Friday morning would reverse the entire emotional landscape in a matter of hours. Friday, January 30th. Before the cash open. Before most people are fully awake. A new headline hits. A new Federal Reserve chair pick is announced. Kevin Warsh. And if you are not a market person, that may sound like a forgettable personnel decision. Just another Washington appointment. Another face in a suit. But if you understand what the Fed represents, that name changes the trade instantly. Because Kevin Warsh is associated with monetary discipline, tighter conditions, and a harder money posture. In plain English, the market reads that name and hears something very different from what it heard on Tuesday. Tuesday, weaker dollar. Friday, a Fed signal that implies stronger dollar credibility. Do you see what that does? The exact same participants who were pushed into one direction earlier in the week were now being forced to reverse. Dollar shorts suddenly looked wrong. Metals longs suddenly looked crowded and vulnerable. The trade that had been rewarded on Tuesday was now being punished on Friday by a completely different signal from the same political orbit. That is where the trap shut. Because markets can survive bad news, what they struggle to survive is violent contradiction when positioning is already extreme. A normal correction from that kind of reversal would have hurt. Silver maybe drops 15%. Gold sells off hard. Momentum gets reset. Painful, but manageable. That is not what happened. What happened was much more severe, and that is where the third piece enters the story. China. To understand why the move became catastrophic instead of merely ugly, you have to understand one basic truth about metals markets. When prices break sharply, there is usually a buyer waiting below. There is usually somebody willing to step in, absorb supply, and provide a floor. For silver especially, China has often played that role. Industrial demand, solar demand, electronics, EV supply chains. A giant physical appetite that can stabilize a falling market when paper traders panic. But on this Friday, at the worst possible moment for longs, that stabilizing force stepped away. The Shanghai Exchange raised margin requirements and backed off. Instead of acting like the buyer of weakness, it allowed the weakness to deepen. Now put the pieces together. American traders are already forced to unwind because the policy signal flipped. Leverage is already vulnerable because the market is crowded, and the physical buyer everyone expects to show up does not show up. That is when a sell-off stops behaving like a correction and starts behaving like an air pocket. Because once selling accelerates in a market with no natural bid underneath it, price does not gently descend. It gives way. That is what Friday looked like. Stops started firing. Margin calls started hitting. Profits that existed on Thursday night turned into liquidation notices on Friday afternoon. Silver broke level after level. First the obvious zones, then the big round numbers everybody swore would hold, then the deeper levels that only appear when panic starts feeding on itself. $121 became $115, then $110, then below $100, then lower still. In 6 hours, silver lost about 40%. Gold dropped from $5,600 to roughly $4,700. Leveraged products were obliterated. A trader who thought he was riding momentum woke up inside a forced unwind. And the number that should stay in your mind is not just the percentage, it is the speed. This much destruction this fast does not feel like a market thoughtfully digesting information. It feels like a market being pushed through a door that was deliberately opened at exactly the right time. But the most revealing part came after the dust. Because once the panic settled, the paper trail started telling a different story from the one flashing on screens. On Friday, around 531 tons of silver contracts traded in Shanghai. At first glance, that sounds like a giant liquidation wave. Sounds like massive real selling. Sounds like holders desperately dumping metal. Then you look at the physical side. Physical silver withdrawn from Shanghai vaults that day? 0. Not low, not reduced, 0. So ask yourself what that means. Hundreds of tons worth of contracts changed hands. Screens screamed collapse, price said chaos. But the underlying metal did not move. Not a single gram leaving the vaults. That does not look like a true physical evacuation. That looks like paper changing hands while the real metal sits still. It looks like a transfer of positions, not a genuine evacuation of physical supply. And then it gets even stranger. By Friday's close, the paper price in New York had silver around $84. In Shanghai, the physical market was closer to $122. In Tokyo, Physical was reportedly changing hands around $150. Same metal, same day, wildly different prices. This is where the whole normal correction story starts to break apart. Because if the paper price is real, why is physical so far above it? Why are dealers still charging far more for actual metal? Why were inventories already tight before the collapse? Why would a seller with sold-out inventory suddenly decide the lower screen price is the truth? They wouldn't. The paper market was telling one story. The physical market was telling another. And that spread matters, because a market in healthy balance does not usually tolerate such a huge disconnect between the promise of metal and the metal itself. Now let's widen the frame. Friday, January 30th was not just any trading day. It was month end, the last trading day of January. Go back 1 month. December 31st, another month end. Another sharp silver drop, about 15% in a single day. Then January begins. Silver recovers and rips to new highs. Then January 30th arrives. Another month end, another collapse. This time far worse. Same calendar pressure, same kind of damage. And once you notice that, the next question becomes impossible to ignore. Why does month end keep showing up at the scene? Because month end is when balance sheets matter. Month end is when financing pressure matters. Month end is when institutions have incentives to clean things up, close things out, meet requirements, and protect appearances. Now add one more detail. On December 31st, the Fed's standing repo facility injected a record amount of dollars into the banking system. Record. And the banks receiving that liquidity are the same class of institutions that have historically carried major short exposure in silver. Then, on January 30th, as metals were imploding, Washington was again buried in chaos, with shutdown pressure hanging over everything. Different headlines, same kind of stress window. If you think that means nothing, fine. But 2 month-end hits in a row, both during high-pressure liquidity moments, both damaging silver, both followed by the same tired explanation of market forces, is at least enough to make a serious person stop and ask harder questions. And we are still not done. Because the exchange itself had been tightening the screws for weeks. December 12th, margin hike. December 29th, another hike. December 30th, another one. January 28th, 3 days before the crash, the whole margin framework shifts again. 4 hikes in 6 weeks, roughly an 80% increase in the cash needed to hold positions. This is where people who do not trade leverage often miss the real mechanism. Margin hikes are not just technical changes in the background. They alter survival. They force behavior. If you are long silver, sitting on gains, and the exchange suddenly demands dramatically more cash to maintain that same exposure, you have 2 choices. Add cash immediately, or sell. And most traders do not have endless spare capital sitting idle waiting for repeated margin changes. So when the crowd is leaned the same way, and margin requirements keep rising, the structure becomes fragile even before price breaks. Then price breaks. Then forced selling begins. Then more margin stress hits. Then people who wanted to hold are no longer allowed to hold. That is how an already vulnerable market turns violent. And the detail that should bother you most is what happened after the crash. They raised margins again. After the damage, after the blood, after the wealth destruction. If the goal were simply stability, you could argue for relief after the event. Let the market breathe. Let volatility settle. Let participants recover. That is not what happened. Pressure before the fall, pressure during the fall, pressure after the fall. At some point, risk management stops sounding neutral. And once you place this event next to 1980 and 2011, the pattern becomes harder to dismiss. In 1980, silver went parabolic. Then the rules changed, leverage was effectively strangled, rates exploded higher, and the market collapsed. In 2011, silver surged again. Then margin hikes came one after another. 5 hikes in 9 days. The rally was broken. It took years to truly recover. Now 2026 gives you a third version of the same broad sequence. Powerful run, crowded longs, margin pressure, policy reversal, violent break, panic everywhere. 3 episodes across 5 decades. Same metal. Same type of threat. Same kind of solution. And here is the part that should really make you pause. While paper holders were panicking, central banks were still accumulating gold. Not dumping it, buying it. The dollar's share of global reserves has been trending lower. Gold's importance inside reserve portfolios has been climbing. In other words, The same system that publicly treats precious metals like outdated relics continues to treat them as strategic assets when real reserve management is involved. That contradiction matters, because when institutions quietly accumulate while retail is pressured into disorder, you are not watching confidence, you are watching hierarchy. Now I want to ask you two things. After seeing the timing, the margin hikes, the paper versus physical gap, and the repeated month-end pattern, do you believe this was just a normal correction? And if paper price is all that matters, why does physical keep refusing to obey it? That is the heart of the story. Paper can be dumped, contracts can be created, leverage can be squeezed, but a bar of metal sitting in real hands is not a screen price. It is not a promise. It is not a position that can be forced out of your account because an exchange changed a percentage overnight. That is why these episodes matter so much. Because every time gold and silver start sending an uncomfortable signal about paper money, leverage, and trust in the system, the response seems to look strangely familiar. A narrative appears. Pressure builds. Rules tighten. Panic does the rest. And then people are told to call it normal. I don't. I call it a 72-hour operation built on contradiction, illiquidity, leverage stress, and paper dominance. I call it a message. The message is that the system still fears what precious metals represent when they start moving too far, too fast, and too publicly. Real money, real scarcity, and a price signal that can embarrass paper. So here is where we end. Tuesday set the trap. Thursday created the euphoria. Friday triggered the execution. The contradictory signal on the dollar. The Warsh announcement. China stepping back. The month-end pressure. The margin hikes before and after. The paper flood with no physical movement. The giant gap between New York screens and Asian physical pricing. Taken one by one, each piece is interesting. Taken together, they form a pattern that is almost impossible to ignore. They called it volatility. They called it a correction. They called it healthy. But healthy markets do not usually vaporize that much wealth that fast, while the physical side refuses to confirm the panic. This looked scripted. And whether you agree with that conclusion or not, one fact remains. The people who understand the difference between paper chaos and physical reality are the people who survive episodes like this with their minds intact. If this opened your eyes, subscribe now and stay close, because these moments never make sense if you only watch the headline after the damage is done. And tell me in the comments, after everything you've just seen, was Friday a real crash, or was it a controlled demolition? And second, what matters more to you now, the paper price on a screen or the real price of metal in hand? Send this to one person who needs the full picture before they make a fear-driven decision, because the script only works on people who never realize they are inside.